Good afternoon, class. Tonight we're looking at a very short and interesting standard, IFRS 5, and hopefully we should be out of this class within an hour or less, but I'm sure it won't exceed that. So we're looking at IFRS 5 on non-current assets held for sale and discontinued operations. So this standard, IFRS 5, looks at two items. One is non-current assets held for sale, which is quite different from discontinued operations. So these are two separate items that we're going to look at today. So majorly, the major part is the non-current assets held for sale. And from the name, non-current asset held for sale, this phrase, the way it is, requires very little introduction because the expression itself says it all, what it means. Non-current asset held for sale, meaning that you have a non-current asset that you are now holding for sale. Then the question is, why are you holding it for sale? Because non-current assets in their very nature, according to IAS 1, they are generally assets that you expect to use, you expect to get benefit from for more than 1 year. Non-current assets are not items that you hold for sale. You don't hold non-current asset for sale. It's current assets that you can hold for sale, like inventory. It's okay to hold those ones for sale. But here we are today. We are looking at that it's actually possible that you can have a non-current asset that you have then decided that you want to hold it for sale. This means that, first, non-current assets in their nature, non-current assets are not held for sale in their nature. They are not held for sale. Non-current assets are supposed to be used within the entity for many years. Is in their nature, according to IAS 1, you are not supposed to hold them for sale. So that means that for us to have a standard that talks about a non-current asset that is now held for sale, that means we need to understand why. Then the two things or three things that, or three issues I will teach you under this non-current asset held for sale is that at what point can you classify a non-current asset as held for sale? That's the first important thing here, and it's the most important here. The conditions, the occurrences, the situations that can arise that you would have to then classify a non-current asset as held for sale. That's the first thing we need to learn. Because non-current assets should not be held for sale. So what would have happened? What are the conditions that must be met before you can say, okay, these non-current assets, I want to hold it for sale? And let me not assume, I want to believe that every one of you here knows that when we say non-current assets, we are talking about PPE. We are talking about intangible assets. We are talking about majorly financial assets. We are talking about maybe investment property and many others like that. Those are non-current assets. These items, you use them for the long term. Now we are saying it's possible that they can be held for sale. So we need to learn the conditions that must be met before they can be classified as held for sale. Then when that is learned and we understand that the conditions that must be met, then this standard will also teach you how do you then measure measurement of non-current assets held for sale. How do you measure a non-current asset held for sale? And finally, how do you then present them? Presentation of non, because when you are saying that these non-current assets, you now want to hold it for sale, can you still present it as a non-current asset? Or how do you then present it? We need to look at that. And finally is disclosures. Okay. Okay. So all these four headings should not take me so long for me to cover it. It's something I would teach you within 15 minutes, these four headings. And if you have any questions, please don't hesitate to ask at any point in time. So the first here is classification. Classification of a non-current asset held for sale. This is the most common one you always find in the exam. They would always ask you that what are the conditions that must be met before a non-current asset can be held for sale. So primarily, there are two conditions before you can classify a non-current asset as held for sale. Two. And number one is that the non-current assets must be available for sale in its present condition. The non-current assets must be available for sale in its present condition. So before you can go ahead to classify a non-current asset that's held for sale, it means that that asset must be available for sale in its present condition. If it is a machinery or a plant that you are using in your factory before, you now decided that you want to sell it. You decided that, okay, you want to sell it. Okay. So when you have made that kind of decision, then we say that that plant becomes a plant held for sale. So before you can classify it as held for sale in your books, it means that that plant must be available for sale in its present condition. And that means that if a buyer should walk in today, if a buyer should walk in today, you must be ready to release the asset immediately. You must be ready to release the asset. You cannot say you want to make one adjustment or the other. You cannot tell him to come back tomorrow or next that you want to meet some demands. No. The asset must be ready for sale, must be available for sale in its present condition. And number two is that the sale of the assets must be highly probable. Must be highly probable. So when we say the sale is highly probable, because you cannot just say this and move on. You need to tell the examiner what highly probable means. It means 5 things. And you must be able to tell them these 5 things in the exam. It's extremely important you can do that. Number one is that the management of the company, the management must be committed to the plan to sell the assets. It must be committed to the plan to sell the asset. Number two is that there must not be a change in the plan to sell the assets. Number three is that the asset must be sold within 1 year. Number four is that the asset, in fact, before then, let's say there must be an active program. There must be an active program to locate a buyer. And finally, the asset must be marketed at fair value. Let me put it that way. At fair value. I just shortened it. I could elongate this, that the asset must be marketed at a price that is reasonable in relation to its current market price. It's the same thing as that the asset must be marketed at fair value. So you must be able to have this at your fingertips in the exam, because of course they ask it often. So if all these are present, and the thing is that they must all be present. If all these are present, then you can classify the asset as held for sale. And I hope you understand when I say classify. It simply means that as soon as an asset that you're using, a non-current asset, as soon as you now have the intention of selling, because the way I started, I said non-current assets should not be held for sale. But I mean, if you then decide that you want to sell it, it means that that asset, its classification can no longer be plant if it's a plant, or it can no longer be a building if it's a building. It can no longer be a motor vehicle. If it's a motor vehicle in your book, it can no longer be that non-current asset anymore. In fact, it now becomes a non-current asset held for sale. When I say it now becomes, I mean you would then classify it as a non-current asset held for sale. But before that can happen, it's not just about saying, okay, you want to sell. No, these two must happen. It should be available for sale in its present condition. The sale must be highly probable. And when we say highly probable, all these five must exist. You must be committed to the plan to sell. And you don't come and say you want to change. And you must sell the assets within 1 year, meaning that you can only classify an asset as held for sale in just 1 year. So we expect that you sell the asset off within 1 year. And you must be doing marketing. There must be an active program to locate a buyer. When you're doing your marketing, market it as a price that is reasonable. So these are the conditions that must be met before you can classify an asset as held for sale. Now, you see, when we say one thing here is this, typically you find out that it might be some scenarios where you're unable to sell the asset within 1 year. What then happens? Naturally, you should reclassify the asset back to its non-current assets position. You should reclassify it back, because since you can't sell it, right, within 1 year, so you should reclassify it. But there are some situations that if you can prove that you are doing marketing, you are committed to sell, the price is reasonable, but still you cannot get a buyer, that means that situation is beyond your control. So the standard still allows you to continue to classify it as held for sale. So it's okay. You can continue to classify it as held for sale. Since it's not your fault, you've made a lot of effort and you're still committed and all of that. Just that you are unable to sell it. So it's fine. It's okay. That's one thing I need you to note relating to this one here. Another one is that, you see, when you classify an asset as held for sale, okay, it's different from, don't confuse that with when an asset is not used again. It doesn't mean that that asset is not being used, okay? You are still using it. It's still functional. It's just that you now want to sell it. You have the intention of selling and you are ready to sell it as soon as you get a buyer. So don't think it means you are not using it again. No, you are still using it. Just that you want to sell and you're ready to sell it immediately. Okay. So the examiner might trick you with an abandoned asset. So an abandoned asset is not an asset held for sale. Okay. It's not an asset held for sale. So it doesn't classify as that at all. So an abandoned asset is still a non-current asset. So if you have a motor vehicle that you just parked in your compound and you are not using it, it's just there. That one is different from asset held for sale. That one is not held for sale. Just that they just decided not to use it. So don't mix them together. They are different. Okay. So I needed to clarify that. Okay. Now that's it for classification. Now I can easily move to measurement, but let me try you with two questions. Let me see if you would be able to do well. Let's look at this question together. It says on 1st December 2013, a company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. The company does not intend to discontinue operations currently carried out in the facility. At 31st December 2013, there is a backlog of uncompleted customer orders. The company will not be able to transfer the facility to the buyer until it ceases to operate the facility and has eliminated the backlog of uncompleted customer orders. This is not expected to occur until May 2014. Can the manufacturing facility be classified as held for sale at 31st December 2013? Okay. I mean, this is quite straightforward. So they want to sell, they say they are committed. In fact, they have found a buyer. But they said they are not ready to discontinue operations right now because they have a lot of the manufacturing facilities, they have a lot of customer orders that they need to fulfill. And it will take them until May next year before they can complete or fulfill those orders. But there's a buyer they are committed to sell. So, and this is still December 2013. So can we classify that this manufacturing facility as a non-current asset held for sale? I need one
No,
of you to name this.
No.
No? Okay.
the
Why?
answer is no.
Why, Jamie? Jamie. Yeah, Jamie, tell me why.
Okay, so the reason why we can't classify it as a non-current asset held for sale is that one of the conditions that need to be met for an asset to become held for sale is that the seller must ready to transfer the possession immediately. We have a potential buyer here, but they are not ready to release the assets. So that reason why I said the answer is capital no.
That's correct. That's absolutely correct. So is no, and that's just the reason they are not ready to release. So this asset is not available for immediate sale in its present condition. So and that's it. So and If they had said that probably can it be classified as that May 2014, we would have said yes. Because May 2014, then they will be ready. But we are looking at
1 year.
exactly. Yeah, 1 year. And I mean, the question is asking about December 2013 right now. December 2013, they are not ready. They are not ready. So that's good. So let's look at this other one. This talks about May Limited had the following assets at 31st March 2014. A property that it offered for sale for 10 million during June 2013. The market for this type of property has deteriorated, and at 31st March 2014, a buyer had not yet been found. Management does not wish to reduce the price because it hopes that the market will improve. After 31st March 2014, the entity received an offer for 8 million, and the property was eventually sold for 7 million during May 2014 before the financial statements were authorized for issue. And the property be classified as held for sale. Its year end is March. Okay, this one too is quite straightforward. So its year end is March. So, and they said they are really referring to March 2014, that he has a property that he wants to sell. He's putting it in the market at 10 million in June. That's before the end. And the market for this type of property has deteriorated. So, I mean, unfortunately, maybe the prices are down in the market as at the year end, and they haven't found a buyer as at the year end. Management is not ready to reduce the price because they believe the market will improve. So, as at the year end, which is March, they received an offer of 8 million. I mean, they did not accept because they sold the property for 7 million in May next year. I mean, not next year, after the year end, before the financial statements were authorized for issue. So, as a March, can we classify this property as held for sale? Anybody?
I think no, as at March, because from June to the property earlier was okay. With here the following assets, a property offer the sales of 10 million. I think from that June to March is not up to a year already.
Okay.
I think no.
Okay, what?
I would
And
say
no, because okay, so
no. Sorry, you can speak. Sorry.
So
okay. I
okay,
think
so
no, because the managers did not wish to reduce the price. And if they were trying all efforts to sell that asset, they will reduce the price of the asset to meet the market demand. But since they did not wish to reduce the price, open the price of that market will increase later. I don't think it should be classified. That's what I think. I'm not sure.
Okay, and that's the answer though. So you're correct. So it's not going to be classified, and the major reason is that they are not marketing it at a price that is reasonable in relation to its current market price. I mean, they want to sell it for 10 million. That's why they did not find a buyer as at the year end, and they are not ready to reduce the price. Somebody even came for 8 million. Apparently, they did not sell. Eventually, they even sold it lower in much later after the year end. But the key thing here is this: as of March, were they able to? Can we classify it as held for sale? Did they meet that condition? No. Yes, they want to sell, but as far as we are concerned as a March, the sale is not highly probable because they are not marketing it at a price that is reasonable. Because if they had agreed to this offer, if they had reduced their price, they would have sold it. So the reason why we cannot classify this as held for sale is because their pricing is not reasonable. So you're absolutely correct. Okay, good. So that's it around classification. Probably I would throw you more scenarios for you to attempt, but it's really around all of that. So you will see that in those scenarios, the core thing or the core principle there is this: we are much more concerned about the year end. We are concerned about the reporting dates, that did they meet all these conditions at the reporting dates. Like the last question we looked at, yes, they were able to sell it much later, like in May 2014, but the reporting date is March 2014. Did they meet all those conditions as at that date? No. For that reason, you cannot classify it as held for sale. I will send you more scenarios just for you to glance through and get used to classification. Now, so how do you measure a non-current asset held for sale? So when you have classified that an asset as held for sale, how do you measure it? Very simple. It's measured at the lower of the carrying amount of that asset and NRV. Everybody knows that NRV is fair value minus cost to sell. So the lower of these two, whichever is lower. Okay, yeah, this is logical, right? Because the carrying amount would be the value at which the asset is already in your books, right? That's the carrying amount. The NRV is the selling price. So which makes sense in this case because now we want to sell the asset. So the relevant value we should look at should be the lower of these two. So you see, if you have, let's say, a carrying amount of 10 million, and we have an NRV, net realizable value, of 12 million. That means it's going to be in our books at 10 million. So that means that we are not making any adjustment to our books because we are continuing to measure it at the value it is in our books. So whenever the carrying amount is lower, then fine, nothing. You do nothing. You do nothing. Just continue to carry it in your books. But if you find yourself in a scenario where the carrying amount of, let's say, 100 million, and the net realizable value is around 80, net realizable value becomes lower. So I was saying that since if you have a where the carrying amount is higher than the net realizable value, that means we have to measure this asset held for sale at net realizable value. So which means that we'll now have to write down, we'll now have to adjust our books from 100 million to 80 million. So logically, when you need to reduce your assets, it means that you are going to credit that asset, in this case with 20 million. Who can tell me what we will debit? Can anybody tell me what we will debit? That's what, in this case, that's an impairment loss. You debit impairment loss to P&L. Please take, this is the most important thing in measurements here. You debit impairment. So anytime you have to write down your carrying amount to its NRV, anytime the NRV is lower, it means you need to write down that carrying amount to its NRV. So when you need to reduce the value of the asset, you credit the assets. You simply debit an impairment loss. We call it an impairment loss to P&L. So, I mean, if you remember what I taught you in IS 36, you see that Why are we calling this an impairment loss? Because an impairment loss is more of lower between carrying amount and recoverable amount. So how is impairment loss now lower of carrying amount and net realizable value? How is that now the difference? How is impairment now the difference? So IS 36 has allowed IFRS 5 to call this impairment loss just for this purpose. Okay, so it is allowed here. Okay, so that's the major part of how you measure a non-current asset that is held for sale. Now, the second thing in measurement is that when you classify a non-current asset as held for sale, depreciation will cease. Depreciation will cease on the non-current assets. As soon as you classify a non-current asset as held for sale, you stop depreciating that non-current asset. You will stop. Don't depreciate it again. And the reason is that your intention now is to sell the assets, not to use the assets. It's only an asset that you are using that you depreciate. An asset that you want to sell, you don't depreciate it. So depreciation will cease on that non-current asset. Okay. And may I remind you that, you see, this one that we debited impairment loss, do you know that if on this same asset, I'm just assuming, if on this same asset, if there was a previous revaluation surplus, if there was a previous revaluation surplus on this asset, you won't just simply debit P&L with this impairment loss. You would go and debit OCI to the extent of that previous surplus. You would debit OCI to the extent of that previous surplus, just to net off that surplus. It is, if you have any excess, then that one can go to P&L as an impairment loss. So that principle always applies. It will always come up if it's that situation we find ourselves. Finally, on measurements, is that if you're unable to sell an asset, that means if you can't sell it, you have to reclassify the assets back to non-current asset. You will reclassify it back to non-current asset. So an asset that you classified as non-current asset held for sale, but you could not sell it. You are unable to sell it. So you reclassify it back to what it was. So reclassifying it is not a challenge because it's like you are moving from one class of assets to another class of assets. The major challenge is, how do you measure it? How do you now measure it? Okay, so you are going to measure it at the lower of its NRV. I mean, whatever is the value you are carrying it now, and its carrying amount minus depreciation from the date of classification till now. So this is saying that when you reclassify an asset back to a non-current asset, I mean, I think it would be better if I should attach a figure. Let's say in 2024, you pushed an asset and you will classify it as a non-current asset held for sale. and the value was, let's say, 300 million. And this 300 million was the NRV. And at that same date, the carrying amount of the asset as at that date was 350 million. And usually you charge depreciation at 10%. But because IFRS 5 says the lower of the two, so from 2024, you started measuring the asset at 300 million. And of course, when you will not depreciate because depreciation will cease going forward. But in 2025, you could not sell the asset, so you need to reclassify it back. Reclassify it to non-current asset back. So when you want to reclassify that to non-current assets, you are going to reclassify it at the lower of this 300 million because it will still be at 300 million in your books, the net realizable value, and the 350 million minus the depreciation you were supposed to have been charging that you did not charge. Because that is 350 minus, let's say, depreciation in 2024, depreciation in 2025, that is almost 75 million. So that is giving us around 275 million, I guess. So it then becomes the lower of this 275 million and this 300 million. So when you will classify a non-current asset held for sale back to its normal non-current asset, is usually measured at the lower of its net realizable value and its carrying amount minus depreciation from the date of classification till now. Okay, now that is everything around measurements. Let's look at some questions. Okay, somebody is raising up his hand. Can you ask your question, Jamil?
Okay, I think what I wanted to ask is what you just explained. I wanted initially I wanted to ask that, is it possible for a company to lower the price when they are maybe they want to put the asset back after a year, they couldn't get a buyer, then they decide to reduce the price in order to put the assets back to the market as an asset held for sales. So, but I think it's what you just explained, that by mere of reducing the or charging the depreciation of the previous years, the price can still come down. So it shows that what I intended to ask has been answered. That's why I lower my hand.
Okay, good. Okay. Let's look at this. It's actually very straightforward. There is nothing technical around this. It's always straightforward. So you'll find them that they don't ask a single question on measurements. They will mix it with some other things. And after today's class, I'll be throwing you those things. They'll mix it with some other things that you have learned before, like that, just to make it. Like, look at this now. They said an asset is reclassified as held for sale when its carrying amount was 10 million. Its fair value less cost to sell is 7 million. How is the asset measured? It's at 7 million because that's the lower. That's the lower. So there's nothing there. Another one is an asset is reclassified as held for sale when its carrying amount is 20 million. Its fair value less cost to sell is 24 million. How is the asset measured? It will continue to be measured at 20 million because it's the lower. However, for this first one, for the fact that it's the fair value that is lower, it means that we need to adjust our books. That from 10 million to 7 million. So we need to credit the asset and debit impairment loss. So there will be a 3 million that will go to impairment loss account. There will be a 3 million that will go to impairment loss account. Okay. So I have checked what I want to teach you. I've checked this. I've checked this. Remaining presentation. So the only thing on presentation is this. When you have a non-current asset held for sale, okay, it will be presented now as a current asset, as a separate line item under current assets. Because, I mean, it's now a current asset because you need to sell it within 1 year. It will no longer be a non-current asset anymore. It is now a current asset. It will just be there as a separate line item. Where is it? I think there is a template here. Yeah, look at it. Look at it here. Under current asset, you see it as a separate non-current asset held for sale. And it could be any non-current asset. It could be PPE, it could be plant, it could be building, it could be whatever. So you won't just call it non-current asset. You will call it the name of that asset itself, whether plant held for sale, building held for sale, something like that. But it becomes held for sale, right? If there is any associated liability with that asset, you put that one too separately. Okay. And I think it's important I mention that what if you have like a group of assets that you want to sell? If you have a group of assets that you want to sell, the standard calls that disposal group. So that also can fly. You just need to group them together and call them disposal group, a group of assets that you want to sell. So that hardly you hardly find that in your exams anyways. Okay, another person wants to ask another question. Can you please go ahead, please?
Good evening, Mr. Wasil.
Hi.
Please, I don't know if you can repeat on the presentation aspect.
Oh, okay. I said it will now be presented as a current asset. It will be presented as it was a non-current asset before, but now it will be a current asset.
Okay.
And I showed you this template here. You present it separately on its own as a non-current asset held for sale.
Okay.
So I said that it could be any asset. It could be plant. It could be any non-current asset. It could be plant. It could be building. It could be machinery. Whatever it is. It could be investment property held for sale, as the case may be. And finally,
Thank you.
disclosure. You're welcome. And finally, is disclosure. So when you classify an asset held for sale, you need to tell us the nature of the asset, the description, which asset are you selling in the notes. You need to tell us why. Why are you selling an asset that you were using before? Why are you selling it? You need to also tell us that if that asset if it belongs to a segment or a branch of your business, you need to let us know which segments. I mean, that's if it's applicable to you, if you have segments. And when you were classifying it or when you were measuring it, if there was any gain or loss, that impairment loss I mentioned, when you need to write the carrying amount down to its net realizable value, you have to book an impairment loss. That impairment loss needs to be properly disclosed. It needs to be properly explained that this impairment loss, it was as a result of an asset that we classified as held for sale. You need to explain that to us very well. Okay, and that is it on non-current assets held for sale. Now, within the short minute I have left, discontinued operations, okay? It's very similar to non-current asset held for sale, but when it now goes beyond just an individual asset, when it becomes you selling either a component of your entity, like a major line of your business or a geographical area of your operations or your subsidiary. I mean, when you have plans to sell a component of your entity, then that one has gone beyond an asset held for sale. And that is why we have a discontinued operations. So it is a component of an entity that is either disposed of or is classified as held for sale. Is it that you have disposed it of or you want to sell it? And it represents a separate major line of your business, either your branch, either your segment, either another area of operations, or even it could be a plan to sell a major line or geographical area of operations, or it could be a subsidiary that you want to sell. These are components of an entity that you want to sell. Then that's what we call discontinued operations. Discontinued operations. So that's the first thing, the definition, understanding that discontinued operations is different from asset held for sale. Discontinued operations is a component when you want to sell, when you have plans to sell, or when you have already sold a component of your entity, which is like a branch, a subsidiary, an area of operations, like that. That's a discontinued operations. So when you have that type of situation, how does it impact your books? This is how it impacts your books. The major thing here is this. Let me show you this. When you have a discontinued operations, it is expected that when you're presenting your statement of profit or loss, you need to separate continue operations from discontinued operations, which means that you have to segment your P&L statement showing your performance from continuing operations and your performance from discontinued operations. When GSK announced that they were leaving early last year, a lot of people were surprised. But in actual fact, when you check their financials as early as 2017, they had already started segmenting their P&L into continued and discontinued because they had already had plans. They had already had plans of shutting down those major area of operations, those line of business. They were already in the pipeline. And IFRS 5 requires that don't wait until you sell. As soon as you have plans to sell, it becomes a discontinued operations. And you need to ensure that your P&L is properly presented in this manner. Continue and discontinued. You need to separate it like this. And you see, if you look at, if you can see this image I'm showing you, when you would have that discontinued operations, you will see that mostly I just have a one-liner item there, profit or loss from discontinued operations. So this is optional. You can decide to present all the revenue, cost of sales, and the way you have presented it for continued. You can decide to present it like that for discontinued also. But this is preferable. Present a one-liner under discontinued operations that this is my profit or loss from discontinued operations. Then in the notes to the account, you can then do the breakdown where you can have your revenue, cost of sales, and all of that. And I can have asked this particular question severally. This one, there was a question they asked that you should discuss the conditions that must exist in order to classify a non-current asset as held for sale and explain the accounting treatment when such classification is deemed necessary. So those 7 points that I made first, those are the conditions. The accounting treatment, this is talking about measurement. This is talking about measurement that is measured at the lower of its carrying amount and net realizable value. And when its net realizable value is lower, that means you will need to write down the carrying amount to its net realizable value. The difference will be recognized as an impairment loss to P&L. And also, when an asset is classified as held for sale, depreciation must stop, must cease on that asset. You get 7 marks cheaply. The second one that is also common is that they will give you a scenario. In this case, they give us a whiskey bottling company that they produce Blue Bull. They call it Swiss Cola. Here's where I'm going. They said they operate 2 divisions. That's where I'm going. So they have Blue Bull division, whiskey division. So they will now tell you that one of them had challenges. Yeah. They say management decided to close down Blue Bull division. So they now draw up a plan to discontinue the operations and all of that. They now said on February 1st, 2019, the board of directors approved and immediately announced the plan to shut down Blue Bull. They will now give you like a trial balance of Blue Bull with Cola. They gave us for 2 years, right? And don't forget that they want to shut down Blue Bull. They gave us some information that they incurred. The major part of this information is that they paid some staff severance pay, and there was an impairment loss of 9.5 million. The major thing here is this has to be presented separately because we need to see them, because so that we will know that these are expenses related to that closure. They will now ask you to draft the P&L for the company, for the entire company. So, and it's 10 marks, very simple question. All they just want you to do is that this Blue Bull that they want to discontinue, just make sure you present this revenue, cost of sales, everything. Present it under that discontinued operations. That is it. And when you get to this severance pay and this impairment loss, make sure you present them separately. This one is an additional cost. Okay, this one is an additional cost. But you see this 9.5 million, they said is already included. It's already in the operating expenses. It's included there. So what you just need to do is to remove it and present it separately. So this is what I didn't have the solution there. So very quickly, your statement of profit or loss will look like this. The same thing you do for 28. I mean, the major impact is just 2019. But the question wants you to do for 2018 and 2019. And it's the same thing I do for 2019 is what I'll do for 2018. So let me just do 2019. So you have sales. Don't forget, you have Blue Bull. You have Whiskola. What is sales of Blue Bull? 235,000. What is sales of Whiskola? 1,570,000. I'll have cost of sales. What is cost of sales of Blue Bull? Oh, is this even a mistake? I don't have to prepare for the two company. I'm preparing for whiskey bottling company. So whiskey bottling company, 2019, 2018. So all I just need to do is to have continuing operations. So this one will not fly at all. I cannot present it separately. The continuing operation is going to be the one that they are still continuing, which is Blue Bull, which is Whiskola. So this is sales of Whiskola. 1570. Cost of sales 505. Then I have my gross profits. Oh, my gross profit be
1065,000.
1065. Then what again? Admin. What's my admin expense? For Whiskola is 311,000. 311,000. Then I have distribution costs 186,500. Distribution costs. Then other operating expenses 124,500. And that's all. Do anybody have calculator there? So that we can have our PBT.
443,000.
Again?
443,000.
443,000. Then they gave us our income tax to be how much? 130,500. I think I can hear rain is falling from somebody's end there. So, what is the profit for the year?
312,500.
310,000.
12,500.
Okay. So that's for the continuing operations. And the same thing you do for 2019, you do for 2000. So in the exam now, you're supposed to do it side by side. You do 2018 too. Everything I've done here, you do for 2018. Then you now do discontinuing operations. You do discontinuing operations. The same thing, you do sales. What's the sales of this one? That's 235,000. What's the cost of sales? That's 175,000. Then I have my gross profits. So how much will my gross profit here now? 25, 35, 60.
60,000.
Then how much is my admin expense? 35,000. How much is my distribution costs? Distribution cost is 20,000. Then my other operating expenditure is 15,000. Yeah. But this other operating expenses of 15,000, there is this 9.5 million that is there already. This 9,500 that is there. So I will have to remove it from here just so that I can present this one separately. Just so that I can present this separately. So I will have my other operating expenses is simply be that 15,000 minus that 9.5. So I'll be left with how much?
5,000.
Yes, so I'll now come and present that impairment loss separately. You see, if you still add these two, it still gives you 15,000. No? But the standard just wants you to present this impairment loss separately. Just want you to present it separately. And don't forget this severance pay of 42.5 million. So can you press your calculator? What do we have as profit or loss before tax? What do you have?
It's a loss.
Of how much?
52,500.
Okay. Then you see that they gave us a credit. That's why they brought in a credit. It was in jacket. Tax credit. So income tax of 3,000. Then that would reduce our loss. Loss from discontinuing operations.
So 49,500.
How much? Again?
49,500. 49,500.
49,500.
49.
Okay,
Yeah.
thank you. Okay, and don't forget what you are doing for 20. I'm just doing 2019. You should do 2018 also beside it. And that is all that's required when you have a component of your entity that has been shut down. When you are preparing your P&L, you need to segment your P&L into continuing and discontinuing operations. Before you go, let me see. Okay, so I just wanted to mention the disclosures required for discontinuing operations. I just want to note it that, okay, you need to disclose the revenue, expenses, and pre-tax profits. You know, I told you that it's either you come and do it like this, the way I've done it here, on the face of the P&L, or you just only put this one in your P&L while you go and present this breakdown in the notes. So that's what this disclosure is talking about. Disclosing the revenue and all of that, the income tax, any related income tax expense, or any related, not even any related expense, not only income tax expense. And if there is still any gain or loss from remeasurement of any of the related assets, the impairment loss that I mentioned, you need to disclose all of those separately. Those has to be separately disclosed. Okay, so that's the entire principle around IFRS 5 on non-current assets and discontinued operations. So I'll just send you more questions. There are some questions here that you can practice, similar to what we have done. Like they have asked this severally. They have asked it at professional, they have asked it at skills. The most recent one is what we have just done. It's the same where they will tell you that these guys have online store, retail outlets. The retail outlet wants to shut down. I mean, just do that segmentation in your P&L. Continuing, discontinuing. And that is all that is required. Okay, so we're going to close it here for tonight. Do you have any questions?
Yes, Mr. Washir. Thank you so much for the time. I wanted to ask the implications of the fact that asset, if at all we have any, on that line of the optimized saying. I wanted to understand if you have any deferred tax assets, what is the treatment like as compared as
Can't hear
within
you.
this?
I can't hear you. Your line is breaking, but I can hear deferred tax assets. So it really have very little impact. The major issue here is this: when you want to discontinue an operations, right? You need to present its revenue, cost of sales, its performance separately as discontinued operations in P&L, while its assets, whether all its assets, you classify them as held for sale. You classify them as held for sale. And if you eventually sell them, then you write them off your books. You write them off your books. All the related liability, you would also classify them as held for sale also. When you eventually sell them, you net them off with the money you have collected eventually. So there is no special requirement as far as IFRS 5 is concerned on specific assets as the case may be. And eventually, IS 12 requires that before you can recognize any deferred tax assets, you must have a history of profitable operations. And we must be able to foresee that you generate sufficient profits from which you can net off your deferred tax asset. So otherwise, you are not allowed to even recognize deferred for such an operations that will do badly. The auditor should not even recognize deferred tax assets for such an entity. So it really have little or no impact like that.